Let's talk a little bit about Apple. Everyone always wants to talk about Apple, right? It's kind of the it stock, it company. You have a $45 billion stake, more or less. How closely do you follow the company? You know, people are concerned they haven't really introduced any new products.
Well, if you have to closely follow a company, you shouldn't own it.
What? Really?
No, if you buy a business, if you buy a farm, do you go up and look, every couple of weeks to see how far the corn is up, and do you worry too much about whether somebody says this is going to be a year of low prices because exports are being affected or anything like that? You buy a farm. It doesn't grow faster if I go and stare at it. I can't cheer for it.
And so Apple is kind of like a farm.
Well, it's a long-term investment.
Hey guys, welcome back to the channel. Due to popular demand, today I'll be going through my stock analysis for Apple and sharing my research on the business. I'll be talking about their competitive advantage, looking at their fundamentals, and at the end of the video I'll be sharing my valuation model for Apple to see if the stock's trading at a fair price. So let's get started. Apple is one of them companies where one doesn't need to explain what they've done over the last 2 decades. I'm sure we all remember when the iPod first came out, and then following that, the rise of the iPhone. Apple has created one of the strongest brand moats in company history, where any product with that little Apple logo sells millions of units around the world regardless of price. Apple does a better job than anybody at convincing customers to pay high margins, and their customers are also extremely loyal. In an interview, Buffett mentions how this was a huge factor for his investment in Apple, and how he could learn from one of his other businesses just how powerful Apple's moat is.
One of the things that I grew to understand was we have a very large retailing operation, the Nebraska Furniture Mart, and if people went in to buy the latest iPhone or whatever it might be, if for some reason we didn't have it, you couldn't sell them anything else. They either went next door, which we didn't want them to do, or they came back. But it wasn't an alternative.
I think this is a really insightful point from Buffett, and it definitely applies to myself. And another point that comes with that is we're willing to pay up for it. One could walk into a phone store today, and there would be dozens of other brands of smartphones for sale. Most of them look similar to iPhones and perform the same tasks, but it doesn't matter. And even though they sell for a quarter of the price of an iPhone, people will still line up overnight at the Apple store to buy the latest generation. Apple's massive brand, combined with their loyal customer base, gives them a huge moat, and they can continue raising prices which customers will happily pay, as they keep adding value to the products and the overall ecosystem. When it comes to company fundamentals, as always, the first metrics I look at are the return on capital employed, the return on incremental capital, and the reinvestment rate, to see if the business is high quality. If you're new here, I made a full video where I explain all 3 metrics in detail and how to use this spreadsheet, so I'll put a link in the description box if you're interested.
What we really want to do is buy a business that's a great business, which means a business is going to earn a high return on capital employed for a very long period of time, and where we think the management will treat us right.
If you've never heard of return on capital employed before, essentially, return on capital employed is really similar to return on invested capital. The only difference between ROIC and ROCE is, in the equation, the denominator is slightly different. With ROIC, the invested capital figure is simply debt plus equity on the balance sheet. So debt plus equity equals total invested capital. And with ROCE, the capital employed figure is total assets minus current liabilities, which can also be found on the balance sheet. I prefer using return on capital employed over return on invested capital because capital employed uses a larger portion of the balance sheet and is harder to manipulate. Both equity and debt can easily be manipulated to show high returns on invested capital, whereas capital employed is much harder to manipulate. In my calculation for capital employed, I also add back R&D expenses, as I consider it additional capital employed within the business. So for Apple, if we look at their return on capital employed, they generate almost a 40% ROCE, which is pretty incredible for how much capital they deploy within the business. Overall, they deploy a massive $250 billion in capital employed, but they somehow generate an insane $92 billion in free cash flow on that capital. Next, if we look at the return on incremental capital and the reinvestment rate, this is where things get a little tricky for Apple going forward. Over a 9-year period, their return on incremental capital employed was brilliant at 47%, but their reinvestment rate was only 20%, which means their intrinsic value compounding rate was only around 9% a year, and that's excluding dividends and buybacks. I think one of the reasons their reinvestment rate is low is because it's basically impossible to reinvest the amount of free cash flow that Apple generates. In the last 9 years, Apple have generated over $500 billion in free cash flow. So it's just not possible to deploy that much incremental capital back into the business. So overall, their return on capital is amazing, but I also think Apple's at the size and maturity where there just aren't many opportunities to deploy capital and reinvest their earnings. And over the last few years, Apple's total capital employed has even been decreasing. So it's really hard to say what the business looks like going forward. I think they'll still generate high returns on capital, but I'm just not sure how much they can grow the base capital, unless Apple come up with some new business segment like the Apple Car, which would open up new reinvestment opportunities for all that cash coming in. The last thing I want to touch on about Apple's fundamentals is their large amount of debt, around $100 billion to be exact. A common method investors use to assess a company's debt is to compare it to their total cash or their total equity, which is where the debt to equity ratio comes from. And Apple is a great example of why using the debt to equity ratio can be a bit misleading when looking at a company's debt. If we look at Apple's balance sheet, we can see their total debt is around $120 billion, but their total equity is only $63 billion. So that gives Apple a debt to equity ratio of roughly 2, which will be considered really high. The problem is, there's this little accounting rule that can massively influence the equity figure of a business, which is caused by stock buybacks or share repurchases. In Apple's annual report, if you go to the balance sheet and you scroll down to the next page, it shows you a full breakdown of Apple's equity. Now, in accounting, when a company repurchases its own shares, that cash is subtracted from the company's equity. And we can see that in 2021, Apple spent a massive $85 billion on share repurchases, and this massively reduced Apple's equity to only $63 billion. So hypothetically, if Apple didn't purchase any shares in 2021, their equity would be $148 billion, which is more than enough to cover their debt obligations. This little accounting rule is the reason why I don't really use the debt to equity ratio when analysing a company's debt, and it's also the reason I prefer using return on capital employed over return on invested capital or return on equity. So overall, I don't think Apple's large amount of debt will be a problem, because they have an even larger stream of cash flow to cover it. Alright, the final piece of the analysis is my valuation for Apple, and I used a simple discounted cash flow spreadsheet to try to estimate their intrinsic value. If you're interested, this spreadsheet is also available to download for free in the description box. All that I ask is that you please smash that like button. So, for Apple's cash flow, I took their free cash flow estimate for 2022 on Ticker. I normally do this when companies are past the 6-month mark, and we're closer to 2022 results than 2021. As you know, I'm usually against using analyst estimates, but if it's only a few months ahead, then Ticker is usually pretty accurate. So to find this figure, go to Ticker, hit Estimates, and then scroll down to Free Cash Flow. And we can see that the analysts think Apple will generate roughly $111 billion in free cash flow in 2022. So I'll use that figure in my valuation. Next, we need the future growth rates for the cash flow. And for Apple, I used pretty conservative growth rates to reflect their massive size and slowing reinvestment opportunities. For the first 5 years, I used an 8% growth rate. And for years 6 to 10, I used a growth rate of 5%. This might sound low, but it still has them reaching over $200 billion in free cash flow by 2032. An absolutely massive sum. As always, I used a discount rate of 10%, and for the terminal multiple, because Apple is a high return business with low growth, I used a terminal multiple of 15. So all up, this gives me an intrinsic value estimate of around $2.2 trillion for the entire business. And with their 16 billion shares outstanding, I have a per share intrinsic value of $135 a share. As always, these are just my estimates, and I'm almost certainly wrong. It's the nature of valuations that are just educated guesses, so we're looking for more of a range than a precise buy or sell figure. Even though I got 135 for my fair value, I would consider their true value to be somewhere in the range from $110 to $160 a share. Anyway, that's my basic stock analysis and valuation for Apple, and I hope you found it interesting. As always, these videos are just a very small part of my overall research, and I'll try to only show you guys the important stuff and not waste your time with all the boring stuff. So overall, because Apple failed my initial checklist by having a low reinvestment rate and a low value compounding rate, I'm probably going to take a pass on Apple stock. Apple is definitely a great business, but my personal investing framework is looking for 10 baggers and 100 baggers, which means I'm looking for businesses with huge runways. And unfortunately, I just don't think Apple has that much runway left, although I could be wrong about that. If you enjoyed the video, please hit the like button as it really helps the channel grow. And if you watched the video all the way to the end, thank you so much for watching. And as always, this video is not financial advice and I'm not a financial advisor. So please always do your own research before making any investment decisions. So that's it for this video. Thank you so much for watching and I'll see you guys in the next one.